Hey, good afternoon, everyone, and Dobro Doshli. Thank you for joining us today for another edition of Business Insights presented by the Canadian-Slovenian Chamber of Commerce. A special welcome to Mr. John Doma, Slovenian Honorary Consul General for Ontario, Treasurer on the Board of the European Union Chamber of Commerce in Canada, and President of the Canadian-Slovenian Chamber of Commerce. We're grateful for your continued leadership and support. I'm Sonia Rosenworth, and I'll be your host on behalf of the Chamber for today's seminar. It's my distinct pleasure to introduce our keynote speaker. We're delighted to once again welcome Robert Kavcic, whose annual participation has become a valued tradition for our Chamber. His thoughtful analysis and clear perspective on the Canadian economy consistently provide meaningful insight for our business community. Robert serves as Director and Senior Economist at BMO Capital Markets, where he's widely recognized for his expertise in Canadian economic, fiscal, and real estate trends. He's frequently featured on major media outlets, including CBC, CNN, Bloomberg, and Business News Network, and regularly contributes to leading financial publications. Since joining BMO Capital Markets in 2006, Robert has played an integral role in shaping economic analysis and commentary across the country. Prior to that, he worked in the research department at the Bank of Canada. Robert earned his Honours Bachelor of Arts in Economics from the University of Western Ontario and his master's degree in economics from Carleton University. We're especially proud of Robert's continued collaboration with our chamber, a connection that reflects his Slovenian heritage and his commitment to strengthening our business community. Robert, welcome to the CSCC Business Insights. Thank you for being with us today. The floor is yours.
So anyway, thank you, Sonia, for the introduction. And of course, I'm happy to, step in here and contribute to the community in any way that I can. So what I'll do here is maybe spend 20 or 30 minutes, just give you a quick overview of what we're seeing in the economy, answer some of the questions that I'm sure you guys have, even things like with respect to what happened over the weekend in the oil market and interest rates, housing, all that type of stuff. More importantly, though, I'll cut it off and just open it up for you guys if you have any questions, if you want to jump back to anything. So that's the idea here. I'll share the presentation and we'll go from here. So first thing I will highlight here, just to give you an idea of the type of uncertainty that's out there in the economy. This is actually pretty representative of what we're dealing with right now. Okay, so this is work done from the Federal Reserve Bank of Dallas, a pretty serious institution. And a lot of the uncertainty around something like AI, where the market just doesn't really know what's going on. So they publish this piece and they say, okay, look, there are a couple different scenarios out there with respect to the development of AI and the economy. Number one is, AI does what technological change has always done, and that is it improves productivity over time. It displaces some workers, the economy shifts, but ultimately the economy benefits from technological development, continues to grow. There's another option where, look, AI is such just a profound development where the technology becomes so good and so fast, and it gets to the point where, autonomous AI effectively does all the white collar work for everybody. And what happens then? Well, per capita income explodes, nobody has to work, and it's effectively utopia, right? Okay, so that's, we're probably dreaming, but regardless. The other side of this is, well, you saw Terminator. What happens if AI doesn't go so well and it turns on us? And well, in that case, the stock market, per capita income, all that stuff doesn't really matter because effectively it leads to human extinction. Okay, worst case scenario. So when the Fed is publishing this type of stuff, this is the kind of environment we're answering questions and nobody knows what the heck is going on with respect to this. Okay, so my personal opinion here is the economy is always kind of a living and breathing organism, right? And what does tend to happen is technological change comes through, as it always has, whether it was the Industrial Revolution, the internet, whatever case you want to pick. The economy does go through a big adjustment period. There will be jobs that are displaced, right? But ultimately, it does drive productivity growth and improves per capita output. And at the end of the day, um, you ultimately find an economy that's better off than when it started. This adjustment is just happening really quickly. So I bring this up not to speculate here, but to just kind of give you an idea of just the magnitude of uncertainty that we're facing out there when we're trying to dig through some of these issues. Okay, so um, that in mind, look at the economic outlook right now that we have, and that's what's on the screen right there. So it's 1.3% growth in Canada this year, 2.2 in 2027. The US economy is running a little bit faster because, various factors on that side of the border, like the build out in AI and things like that are driving growth in the US. I try not to like really focus too much on the decimals when I do this presentation because you guys don't care if growth is 1.3% or 1.5%. Like, what does that actually mean? The way I would characterize this is like the economy driving down the 401 at 70 kilometers an hour, right? So we're going forward. We're not in recession, right? We're not going backwards. We're going forward, but we're going forward below the speed limit, so to speak. And so the speed limit for the economy in Canada would probably be like 1.9 or 2%. So if we're kind of grinding along around 1.3, 1.5%, again, it's indicative that we're not in recession, but there are some headwinds out there that are holding us back. So stuff like the trade dispute with the US, geopolitical concerns around Iran, the fact that we're going through a real estate correction. All these things are kind of just keeping us over in the right lane, driving 70 kilometers an hour when ideally you want to kind of get over to left and speed up a little bit, but we're not quite there yet. Okay, so we'll cover a couple of these issues. First one is with respect to what happened over the weekend. And this is obviously another huge area of uncertainty because we're not really in the business of predicting outcomes of military conflicts like we're seeing with the US and Iran. But from an economic perspective, there's some pretty clear patterns historically that tend to come out of these things. Number one would be that the equity market tends to get disrupted right away, as we've seen over the last couple of days, but ultimately the equity market can kind of put military conflict behind it and continue to move on. And that's what we saw, whether you go back to Iraq, invading Kuwait in the early 1990s, the Iraq War in 2003, Russia, Ukraine. There was a disruption, but the market eventually moved on. Where it gets a little bit more serious if something like oil supply is choked off for a long period of time, and you get significant disruptions like you saw in the early 90s, like you saw in 2023 with Russia and Ukraine, where you do see a significant and prolonged increase in oil prices. What that tends to do is it chokes off economic growth a little bit more. And then probably more concerningly, it drives inflation pressure, right? Because oil prices filter not only through gas prices when you go to the pump, but also through the supply chain. And so policymakers looking at that and saying, well, arguably, if this is the outcome, where we have a shock that kind of just pins inflation a little bit higher for a little bit longer, well, the Bank of Canada is going to be more reluctant to cut rates. The Federal Reserve is going to be more reluctant to cut rates in this environment. So as we've been looking at this over the last 2 or 3 days, we haven't done a whole lot to our outlook. We haven't changed the growth forecast. We have nudged up the inflation forecast. And as I'm sitting here, I'm thinking, look, if we're thinking about the Bank of Canada cutting rates this year or the Federal Reserve cutting rates later this year, well, all this does is it reduces the odds that that's actually going to happen for now. Okay, so that's where we are. Ultimately, the headlines tend to be a lot bigger than the actual economic impact on the ground. So I wouldn't be overly concerned about that from a Canadian perspective at this point. Where it's a little bit more concerning is on the trade front. And so this, of course, is an issue that we've been dealing with for pretty much the course of the past year. The US basically standing up and saying to their closest trading partner that we don't want to do business with you anymore. And for us, that's a big issue because we are a small open economy. And when our biggest export destination turns on us and says we don't want to trade with you, it has a big impact. So this just kind of characterizes the tariff situation that we're seeing in the US. So on the left side of the screen, that's effectively tariffs that are in place from the US perspective on its imports. And so effectively, like we had coming into 2025, we had very minimal tariffs, and the US put through a bunch of emergency tariffs, saw that effective tariff rise up to like 15%, right? So a level we haven't seen since the Great Depression era when we had Smoot-Hawley and we had all of those tariffs that were kind of prolonging that downturn. And that historical precedent is really why the market freaked out about this right off the start. Since then, of course, we've seen the administration like walk back a lot of the measures because they're standing there thinking, look, if we're going to put tariffs on our major source of imports, well, that's inflationary. And we don't want inflation in an economy that already has inflation pressure. So there's been pressure on the administration to scale some of that back, and that's what we've seen. The Supreme Court ruling that we saw has helped as well, where they've effectively ruled, against the emergency tariffs that were put in place. That was kind of beyond the jurisdiction of what the administration can do with tariffs. But there are other ways around that, right? So we don't have to go through all the nitty-gritty of the different sections of kind of the trade code, but what the Supreme Court has taken away, the administration is going to find another way to actually go ahead and put through various tariffs, whether it's Section 122 or like sectoral tariffs on steel and aluminum, lumber, stuff like that. And those are the ones that really actually hit Canada because if you look at the chart there, it's the auto producers in Ontario that are facing tariffs on parts. It's the steel and aluminum producers in Quebec, where you still have, 50% tariffs on those exports, where it's actually starting to hit pretty hard. Um, so that's kind of where we are at. Again, this is another source of uncertainty that's really hard to predict. I personally think there are, three outcomes as we go through this year with respect to the trade file. Number one is Canada and the US just renegotiate USMCA ahead of July, and everything's great. I don't think that's the most likely outcome, to be honest. The worst case scenario is the US has a, option to just walk away from the trade agreement. I don't think they're going to want to do that ahead of midterms either, because there's a big segment of the US economy that is pro-trade, and a lot of states that are, typically swing states. And so the most likely scenario is that the can just gets kicked down the road another year, and we get in an environment where every year, in July 26, 27, and beyond, the US and Canada have to kind of come together and say, are we going to extend this trade agreement? My most likely scenario is they just kick the can to 2027, and we're left with what we are today, which is manageable, but it's still kind of a cloud of uncertainty overhanging the economy. It's another factor that kind of keeps us just running along below the speed limit. Okay, so those are a couple big kind of international factors that are kind of hanging over us and are a little bit hard to predict, but hopefully that gives you a sense of what we're thinking on that. Back at home, it gets a little uh, easier to understand. One area that we have seen progress is on the fiscal front in Canada. So that's a picture of the Canadian budget deficit. It's running about, 75 billion dollars at the federal level right now. I will say one thing here, and we don't make obviously political statements. That's not what we do. Um, Love or hate the Liberal government, it's another prolonged period of big Liberal deficits. But underlying those deficits is a much more favorable policy position for economic growth. And what I mean by that is the prior Liberal government was running big deficits as well, but it was really on the back of bigger government spending, larger public sector, a lot of support and benefit type payments. These deficits have come on the back of personal income tax relief, for households, tax relief for businesses, big increases in infrastructure and defense spending, even measures to do things like eliminate the oil and gas emissions cap in Western Canada for those producers, and even actually scaling back employment at the federal level. So, in a roundabout way, um, you remember what happened during the election campaign? Carney went out there. He was The Liberals generally were really behind in the polls. What did they do? They took the conservative platform, they put a big red sticker on it and called it the Liberal platform. And now the policy that we're actually getting at the federal level is a lot more conservative. It's a lot more pro-growth, even it's still coming under the Liberal banner. Okay, so we take all this into account and we say, look, fiscal policy in Canada is more favorable, and it's probably adding a few tenths of a percentage point to economic growth right now. And so that's where we are. Um, the other big change at the federal level too is on the immigration front. I probably talked to you about this last year as well. The current government has doubled down on what are new, a lot more restrictive immigration targets. And so this is an important story as we get into the housing outlook in a couple minutes. That's just a picture of Canadian population growth over the last 10 years or so in numbers. So typically Canada will see about 400,000 or 500,000 people per year, right, on net coming into Canada through various immigration channels. What we saw, of course, through 2022, three into 2024 was population growth exploded to, almost 1.5 million people per year at one point. It was 3.5% population growth. And that's just an incredible shock for the economy that is typically growing at just under 1%. When you go and drop 3.5% population growth on an economy this size, it has massive implications, right? So implications on things like rental inflation, infrastructure stress, all of that type of stuff. So the different bars, not to get too into the nitty gritty, but the different bars are basically the components of that population growth. And so the really quick breakdown here is those green bars are permanent immigration. So that's immigration that we've always kind of known and thought about. It's permanent immigration, immigrants coming into Canada to live and work under very clearly defined annual targets that Ottawa has. And that's about 380,000 people per year. It actually hasn't changed all that much. The orange bars are births. Um, Canada doesn't have a lot of babies anymore. It is what it is. Uh, I've got three of them, so don't look at me. Mathematically, I've done my part on this, um, but it's a developed world phenomenon, right? Canada's not alone. We just don't have a lot of babies. The blue bars are really the core of the issue here, and that's non-permanent residents. So it's international students, temporary foreign workers. And effectively, what we saw was an area of the immigration program that was completely unregulated and untargeted, um, really got away from policymakers. It became kind of well, this really short story, it became a kind of a backdoor racket for international students to come in and find a pathway to permanent residency that was really unregulated. Policymakers said, look, we have a problem here. Ultimately came out and put a hard cap on those non-permanent resident flows. And what it means going forward, the big takeaway on all of this is that we are in the process right now of going from 3.5% population growth, which was massive, to now zero probably for 2026, 27 into 2028. So it's a huge adjustment. I would actually say it was arguably the biggest economic factor in Canada before the trade war broke out and all that. But it's a huge adjustment for the economy. So 2 or 3 years of effectively no population growth, and then we kind of set back to the baseline of just under 1% once we get out to like 2029, 30 and beyond. Okay, and we'll get back to the housing story in a minute, but this has pretty big implications there. The funny thing is on this too, if you remember what policymakers were saying over the last 3 or 4 years, it was we have a supply problem. We have a supply problem in housing, as an example, right? We need more housing supply. Rents are rising, prices are rising because we need more supply. And we raised our hand and we said, guys, you have a demand problem. You don't have a supply problem. You have a demand problem because this market is never going to be able to absorb 1.3 million people in a 1 year period of time. And the minute these population caps were put in place, no surprise, what happened? The rental market peaked and started to roll over. Prices peaked and started to roll over as well. So big adjustment in the demand curve is underway. Okay, so a couple other things. On the job market front, so unemployment in Canada running at about 6.5% right now. It's elevated, uh, but the job market, by and large, is holding up relatively well. So there's some nuance to this. So if you're in areas like finance, professional services, resources, the job market is actually still quite strong. If you start to look below the surface in areas like manufacturing, trade exposed sectors, and then especially as you go into like southwestern Ontario, parts of Quebec, where the trade war has hit harder, you do start to see an environment where, okay, job market conditions in those particular pockets are actually fading quite a bit. Even in some, skilled trades across markets that have been harder hit by the real estate correction, you're starting to hear anecdotes where the work just isn't quite as robust as it was as projects come to completion, stuff like that. But by and large, the job market is in a pretty decent spot. And in fact, what you actually see here is in this forecast, the unemployment rate comes down over the next 2 years. And that's just kind of the reverse picture of what we saw over the last 2 or 3 years, which is the vast majority, in fact, almost all of that increase in the unemployment rate has been driven by the fact that we've had just a lot more labor supply coming into Canada than we can absorb through new job growth. So what happens when we put pretty hard caps on population growth for a couple of years? Well, labor supply growth falls off. The unemployment rate, as a result, starts to come down as well. Areas like youth unemployment, which has been like 14 or 15%, that's one area too where we're starting to see now signs that the unemployment rate is backing down because that wave of labor supply is crested and has started to move out. So we think we're in a relatively comfortable spot on the job market front. And then so that leaves us then with the inflation picture. So the inflation picture is obviously important because it drives markets, it drives central banks. And we're in a pretty good spot with respect to inflation, but we're not really all the way back to where we need to be from the Bank of Canada's perspective. Okay, so that's picture of inflation in the US and Canada. We all lived through the pandemic shock. We all remember what it was like to see that 6, 7, 8% inflation. That era is behind us now. Okay, we've worked through that. All the COVID era supply chain shocks. That's worked its way through the system. House prices are down, rents are falling, service inflation has stabilized. That's totally fine. We're a little bit stuck still in a couple areas like oil prices now. Of course, if we're going into a regime where we're not at $60 oil, but we're at 75 with a geopolitical risk premium, that's a good, let's call it, say, a good 20-25% increase in oil prices is going to filter through to a couple tenths on inflation. And you probably see it at the gas pump already this morning, right? Directly right in front of everybody's eyes. There's some issues with respect to the trade war, so not necessarily on Canada, because Canada has scaled back its retaliatory tariffs. But in the US, if you're going to put 50% tariffs on your biggest consumer imports, well, the administration is going to go out there and tweet that, China is going to pay a 50% tariff. Well, China doesn't pay a 50% tariff, right? It's the US importer that pays the tariff. And then that importer passes most of that cost on to the US consumer. So one of the reasons why US inflation has been running a bit hotter is because of those tariffs that the US has been put on. That's textbook economic response. And the job market has been a little bit, it's been firm. Wage growth is still passing through. That's not a bad thing, if real wages are growing, but it is technically a little bit inflationary. And then there's inflationary psychology still out there in the economy. And so psychology is a funny one because central banks are always trying to be mindful of what people are thinking, and the real mistake that they're leaning against right now or being careful of is they don't want to cut interest rates too much and then have that inflationary psychology start to spin again and then take us from this environment of what is relatively contained 2.5% inflation and have to go back and fight that whole inflation battle again, because that's going to mean sharply higher rates. And this is a pretty good, give you a picture here of why this inflation psychology is really hard to break. So the funny thing about the 2% inflation target, which we've gotten pretty close to now, is that we haven't actually seen the price level of goods and services fall back to what we consider normal. It's just that the rate at which they're growing has fallen down. So it's a very big distinction, right? The bank targets 2% inflation, which is 2% growth per year. But if you walk into the grocery store, great, you have 2% inflation, but the actual physical cost of that grocery bag that you're pulling out of Loblaws is still like 20, 30% higher than it was pre-pandemic. So it's as the academics look at inflation or the economists and say, great, we're back to 2%. But if you're a family that's just literally going out there and shopping, nothing feels any cheaper. It doesn't feel any better, right? Because the price level is still really elevated. And that's a picture of kind of all the stuff that has seen inflation rates fall back to normal, but the actual level cost of buying that stuff is still a hell of a lot higher than it was 4 or 5 years ago. So there are areas where inflation has been fine. So like cell phone bills, childcare, all that type of stuff, TVs, exercise bikes, clothing, fine. But if you have to eat food, get a place to live, or get yourself to work, the impact of that past inflation episode is still hitting you pretty hard. Okay, so that's what I kind of mean when there's a psychological impact out there in the market as well that is keeping inflation expectations a little bit high. Okay, so that's the kind of macro backdrop. I guess summarize all of that, you can say growth is running below the speed limit, but inflation is running a little bit hot. So what does the central bank do in this environment? Well, the central bank sits there and does a whole lot of nothing. Okay, so the Bank of Canada this year is, in our view, going to be on the sidelines right through 2026. So the Bank of Canada policy rate, you can see it there, it's 2.25%. We think they're on hold right through 2026. The Federal Reserve, you can see we have actually 3 interest rate cuts in our forecast right now. I suspect that in the next day or two, I'm going to convince the guys on my team to pull one of those rate cuts, and we're probably going to have 2 rate cuts later in 2026, just given the inflationary impact that we're seeing in the energy market right now. Okay, so I'll give you, try and keep this really like simple and useful for you guys. 2 big takeaways here. Number one is the Bank of Canada is probably not moving interest rates this year. Okay, simple takeaway. Number two, and this is an important one, I always get this question, Rob, where are interest rates going? And it's a really simple answer right now because interest rates are going where you see them right now. Right. So I say that because the economists and policymakers are always looking for this quote unquote neutral level of interest rates. And the neutral level of interest rates can be very well characterized by what you see out there in the market today. So if you're walking into a bank and you're looking at mortgage rates that are, 3.75, 4%, that's very neutral. That's probably what I would budget for the next number of years. If you're sitting there waiting for mortgage rates to go back to 1.5% to save the housing market, you're going to be disappointed because we're not going there. That was not normal. Okay. The levels you see today are very normal. Same thing if you walk into the bank to, buy a GIC or a 10-year government bond, 3.25%. Those are very neutral yields that you can probably expect going forward as well. So there's always an economic cycle, right? We're going to see rate cuts and rate hikes around that neutral level, but important takeaway here would be go look at what's out there in the market today. This is a very good level to budget for going forward for a number of years. Okay, a couple other things. I'll give you a quick look at the housing market, quick look at, I think, the equity market, and then I'll let you guys take over with questions. So the housing market story, unfortunately, to really do justice to what's going on in the housing market, we probably need a whole hour presentation on real estate itself. But I'll give you the really short story here. So we called this downturn in housing right back at the start of 2022. And it was kind of a controversial take at the time because the market was just ripping to the upside. We said there's going to be a correction here when the Bank of Canada tightens. And we said the correction was going to be measured in years. It was not going to be months or quarters. And we said that because valuations got extremely frothy at that peak. And there are a lot of different ways we measure housing valuations, but they were all just flying off to the charts at levels we haven't seen since the late 1980s. At the same time, you had deeply negative emergency level interest rates that were propping up the market. As we said, we're back to normal on rates now, so we're not going back there. And at the same time, you had peak domestic demand for housing from the millennial cohort. So think about like families like myself with 2 or 3 kids looking for a house with a backyard. The peak of the millennial group is like 35 or 36 years old right now. So they were converging on the market right at a time when speculation was high, interest rates were historically low. And then what did we do on top of that? Just to pour even more gasoline on the fire, we brought in 1.3 million people per year that needed housing. And we threw that on top of a market that was already burning hot. Okay, so this was the kind of the peak of activity in the start of 2022. And we said, well, look, we're always forecasters here. So what happens over the next 5 or 10 years if this is our starting point? Well, if we're starting from a point where everything is actually absolutely maxed out to the positive side, we can't replicate these conditions going forward. So the only path for the housing market is down. And so the path down has been pulling back valuations, getting speculation out of the market, and getting interest rates back to more normalized level. getting immigration back to a more normalized level. And so what this has meant, of course, is across the GTA, Southern Ontario, about a 20-25% correction in home prices. I think we're pretty close to the lows right now. I just don't see a big case to see the market really flip around and start moving a whole lot higher until valuations reset a little bit lower as well. There's some nuance to this too. So if there are questions on real estate, of course, I can answer those. If you're, I'll give you one really important nuance to this too. So we always say location, location, location in real estate, right? So Southwestern Ontario is a pretty tough spot. There are pockets of Canada, like the prairies, Atlantic Canada, where things are actually pretty strong. But even in the GTA specifically, I would probably expect at some point relatively soon, I don't know if it's going to be this spring, but at some point over the next year or two, the single detached housing market, so houses with, 50-foot lot, 3 bedrooms and a backyard, are going to actually start to tighten up relatively fast because there is a lot of demographic demand out there that needs that supply. And we haven't built single attached housing in the GTA for like 15 years. So I think that will tighten up relatively fast. The other extreme in this would be a small bachelor 1 bedroom investor oriented condo where the investor is completely gone and there's a huge pipeline of either investor owned supply or purpose built rental supply still coming to completion that was started under conditions that existed 3 or 4 years ago. Um, I don't know, like put this nicely, that side of the market still has years to work through. Okay, so there's a bit of a distinction there too, depending on what segment of the market we're working through. And again, if there are questions, we can jump back to some of that. Last thing here, just to kind of wrap it up, two things. On the Canadian dollar, I would say we're somewhat bullish on the Canadian dollar. So you can kind of see the level we're at today there, 70, low 73 cent range. I think so when you get a supply shock like we're seeing in the oil market right now, I don't want to put too much weight on what's happening with the war in Iran because I could leave this presentation and conditions are different, right? But typically what happens in this environment is currencies like the Canadian dollar, which are politically secure and oil exporting currencies tend to perform relatively well. So this actually helps a little bit. Bigger picture, there's a kind of a trade out of the US dollar going on as well, where a lot of investors aren't too comfortable with what's happening with the administration south of the border, and they're diversifying some of their assets away from the US dollar. And incrementally that benefits us a little bit. So I don't want to give you a picture of of a really significant Canadian dollar strength. But I think a lot of people were really negative on the loonie last year, and that's proven to not be the right trade. I think there's just kind of a gradual drift up, call it towards like mid 70 cent level in this environment. And then for the equity market too, as I said, like the kind of disruption we're seeing right now tends to be overdone in the short term. I think we're still pretty bullish on the equity market, just given what the economy is doing, especially on the US side of the border, where you do have almost 3% economic growth. You have a really bullish build out of technology and capital spending, really strong earnings growth. The only concern that I have here, like as an equity investor, is that valuations on the US side have become pretty stretched. And the market in the US has become really concentrated inside that AI trade, inside the technology trade, right? So as an equity investor, it's a little bit of a tricky one because we're bullish on stocks, but we're a little bit concerned about how much froth there is in the AI trade. So the way I would be playing this personally, and I'm not giving financial advice here, but um, fundamentally, when we look across the equity market, there are areas like Canada, um, you know, higher dividend paying stocks, lower beta stocks, value oriented stocks, small and mid cap stocks that don't have the same kind of stretching of valuations that we've seen within the AI trade itself. Even at the sector level, stuff like energy, utilities, consumer staples, a lot of that stuff has held up really well, even as a lot of the AI and software related equities have sold off. So I think the takeaway on this front is that the economic backdrop is still favorable for stocks, but you probably got to be a little bit picky and be a little bit mindful of what's happening in that AI and tech trade specifically, where there is a lot of speculation and valuation creep getting in there to just be mindful of. Okay, I think that probably sums it up. So if you want to take a screenshot of one chart and say this is what Robert talked about today. This is probably it. Just a quick snapshot of where we are right now based on our assessment and what our forecast implies for the next 12 months. So somewhat below speed limit growth, somewhat sticky inflation, no movement in interest rates. The equity market still strong, but probably less robust in terms of returns than we've seen over the last couple of years. Real estate correction continues, and the currency on the Canadian side probably actually firms up a little bit over the next 12 months. Okay, so that's my overview. I know there's a lot there's
Thank
a
you.
lot to take in there. If you guys have any questions, feel free. I'll stick around as long as you guys want.
I don't think it's ever been just a small, quick seminar with everything that you present to us. Thank you so much. Maybe I think people have taken the screenshots by now. I invite our participants, if they have any questions, to please put your hand up and we'll call on you.
In fact, can I have
John?
Robert? You focused a lot. I mean, everything you say, I'm pretty well with you, to be honest with you. And I see it on the ground level at the client, at the client base. You know, the problems with excessive investment in housing, and now they're trying to unload them. You know, the workforce leaving. I'm hearing from a lot of people. People are leaving Canada because Canada isn't paved with gold like they thought it was. So I can see all those stats you've got there happening, and it's a double whammy on the housing. But one thing I just wonder, if you look at Europe, with our manufacturing base, and got many clients in that space here, are feeling their order books are down, especially this coming summer, and quite concerned. Um, is there a way that we're going to, like, I'm part of the European Union Chamber of Commerce, which we see an uptick in trade. I just don't know that it'll ever replace the U.S. market. But I wonder, if Europe and Mexico can do something there, because China's not going to buy anything from us. They continue to want to sell, and I think that's why our pricing on products is relatively the same, because it's coming in a lot from there, not from the U.S. Do you guys see any trends that way? Because to deal with Europe, it takes 2-3 years, to get onto somebody's order book, because they work on relationships.
Yeah, it's a fair point. And like this is what the Carney government's doing, is saying, look, if the US doesn't want to trade with us, well, we'll just take our ball and go play somewhere else, right? Which is probably the right response, not necessarily to retaliate, but just look out for ourselves and find alternative areas to trade. And like to your point exactly, um like it's great in theory to say, well, we'll export energy to Asia, but we've ignored pipeline capacity for the last 15 years. So we can't just do that next week, which is when we need it, right? Or in your case, like, yes, we have trade agreements with Europe, but logistically, it's obviously a lot harder than trading with the Midwest United States, which is, a couple hour drive across the bridge. So yeah, that's one area where the supply chain takes a lot longer to respond when we need a response probably right away. And so yeah, unfortunately, the impact is like you mentioned, like the manufacturing base and stuff like that. There are pockets of the economy that are going to be hollowed out for a little bit. Um, so there's not really much of a way around that in the short run. In the long run, maybe there is, but who knows? Like in the long run, we might have a new pro-trade administration in the US anyway at some point. I guess the other thing too that policymakers are doing to counter this too is just domestic stimulus, right? And in Canada, we talked about that, how there's a big wave of federal infrastructure spending and speeding up things like project approvals in areas that in the past were really kind of bogged down with regulation. That will help. And in Europe, it's the same thing too, right? Europe is taking up big increases in defense spending that does help the manufacturing sector. Even if we kind of crisscross our order books, right, and buy from each other, it does help, but it can't completely offset the US economy playing hardball, no.
Thank you. Okay. Andrew, thank you. Andrew Savar.
Thank you, Sonia. Hopefully you can hear me okay. And thank you for this session. It's an incredible lunch and learn opportunity. I'm really thrilled about it. A very quick question about a comment, Robert, you made earlier about the artificially low interest rates in the housing market. What is your prediction, if you can make one, and maybe not prediction necessarily, but higher level? What is your analysis of what will happen in the housing market when some of these 3 to 5 year artificially low mortgage rates reset to the higher level you talked about a little earlier, or the more realistic level, the 3 to 4.5%? Thank you.
Sure. So this is a good question. It's something we have spent quite a bit of time on. So you look at the numbers, and to your point, I think there are something like 1.3 to 1.5 million mortgages resetting through 2026. And the peak of that wave is hitting right in about May or June of 2026. Right. And you think about why, if you go back 5 years, that was the height of the housing market in 2021. And exactly to your point, when you were out there in the housing market in 2021, you were walking into the bank and you were taking out mortgages at like 1.5%. So a couple things. Number one is, this is still one reason why I don't think the market's just going to snap back in the spring, because you have these resets that are going to probably cause a lot of investor-owned inventory to come onto the market, because investors just can't carry at 4% what they took out speculatively at 1.5% 5 years ago. So the condo market, for example, is going to see that kind of continued wave of flipping of properties onto the resale market. So I don't see that tightening up much this year. And that's consistent with the story where house prices, what do they do from now in the aggregate? They've already corrected. Now they just kind of go sideways for a long period of time and don't do a whole lot of anything. I would say more importantly, like the more important aspect of this question would be, what does it mean for like the financial system, right? If we have 1.5 million Canadians resetting into higher mortgage rates. And from that perspective, I'm not as concerned, because, well, there are a number of reasons. One is that if you walked into the bank in 2021 and took out a 1.5% mortgage rate, you actually qualified at probably 5.25%, right? And I remember the real estate industry at the time doing these presentations the question was, Rob, why the hell are we qualifying at 5.25%? Mortgage rates are 1.5%. And well, it's a good thing we did, because it's saving us now, right? Banks are also like, look, they're working with borrowers. If a borrower comes to renewal and is kind of in a stressful situation, the bank can, amortize out, chip off payments a little bit further, things like that, which banks are doing because banks don't want to foreclose on houses. And then the other aspect too is that the Canadian household has actually a pretty strong financial asset balance sheet right now too. If you look at what savings and the equity market has done, there is a lot of liquid assets on the household balance sheet right now that can help absorb some of the increase too. So long way of saying, I don't think this is like a financial system problem where you're going to see a big wave of forced selling, foreclosures, and recession like you saw in the US. It is going to really pin down some pockets of the real estate market for longer, sure. At the end of the day, the household still has to make the higher mortgage payment, right? To your question, and they're going to do that first. So what that means is, they're not going to force sell the house. They're going to make that higher mortgage payment, but they might spend less on discretionary stuff like travel, restaurants, and just consumer goods. And again, another reason why we're just driving at 70 kilometers an hour rather than 100 kilometers an hour because of that. So hopefully that gives you some context.
Yeah, very good. Thank you very much, Robert.
Thank you. Does anyone else have any questions before we close? No? Okay. Well, thank you. Thank you so much, Robert, for your insights. Some scary, some positive. Tony, did you have something you wanted to say? No? You moved your hand. It's like an auction. Don't move any body part. We truly appreciate your time and continued support of the Canadian Slovenian Chamber of Commerce. To the audience, thank you for joining us today on your lunch hour. Recording of today's seminar will be available on the CanSlo YouTube channel. If you go to chat, you can download the link there. John, did you want to say?
Yeah. First of all, thank you to Robert for your phenomenal amount of information you laid out in a very short period of time, Rob. We really appreciate it. And of course, you, Sonia, everybody, this will likely be Sonia's last event that she's going to be hosting, as she's going to be moving on to another position. And Monica, I think, was on this call. She's going to be helping out, Monica Resnick. and won't quite replace Sonia. Monica made that very clear, but Monica's looking to, you'll see her around and help in a supportive role. And I just want to remind everybody too, we got a couple more events coming up. Tim Sesnick's going to speak on a couple things, always tax related for Tim. We do have a golf tournament coming up in the summer. Is it, Sonia, is it July?
July, I think July 25th at
Okay.
Granite Ridge. So that's
Is it
coming
Granite
up.
Ridge? No, I think is it Hidden Lake maybe? Anyways, we'll clarify
Oh, sorry, Hidden Lake. Sorry.
Yeah, okay, good. Hidden Lake, and I hope to see everybody out at that the events there, and we're going to try and get a general meeting to get everybody together and just sort of figure out where we're going to be going, over the next several years. So thank you very much for everybody attending.
Okay, lepo se imejte and upam, da se hmal srečamo to our Slovenian. I think everybody's Slovenian almost, or Slovenian wannabes. We look forward to welcoming you again at our next Business Insights event. You might see me again. Thank you and have a wonderful day. Take care. Thank you, Robert, again.
Bye-bye. File your tax returns.